Welcome to the Deep Dive. Today, we're tackling a really interesting situation, a kind of high-stakes paradox right at the heart of Waters Corporation, ticker WAT. For decades, this company was basically the gold standard for stability, an absolute fortress, really, built on this high-margin, super predictable razor and blades model. But it seems that era might be over. We're diving deep into a massive $17.5 billion question today. What makes a famously stable, 65-year-old company decide to gamble its future? On the biggest, most complex acquisition it's ever attempted, is this a smart acceleration into new growth, or maybe a forced, kind of risky play to escape, stagnation? We've seen the analysis from our sources, and honestly, the numbers suggest the stock, trading around $331 right now, could potentially be worth closer to $446 intrinsically. So the real deep dive here is figuring out what $115 gap, what does that tell us about the risk the market sees?
That tension is absolutely key. We're looking closely at Waters Corporation based on data from October 11th, 2025. And remember, this analysis comes from sources processed by Stock Analytics AI.
Okay, let's unpack this. First, we need to really understand the foundation they're pivoting from. Let's call this first part, Chapter 1. Business analysis, the fortress and the moat.
Right. Understanding that foundation is critical.
Yeah.
Waters really exemplifies the razor and blades model in life sciences. The razors, those are the complex instruments, your liquid chromatography, mass spectrometry, thermal analysis systems, crucial stuff.
And the blades, that's where the real magic happens for stability, isn't it?
Exactly. The blades are the annuity stream. Consumables, software, service contracts. These are consistently high-margin recurring revenues, like $786.6 million from consumables alone.
Wow.
Yeah, and nearly $300 million from software, plus over $400 million from service. It really adds up.
And that model creates incredible stickiness, partly because of their huge installed base, right?
Yep.
Over 150,000 instruments globally.
Precisely. That equipment creates an ecosystem. And what's interesting as you look at the growth drivers is that the recurring revenue, the blades, is actually accelerating faster. It grew 11% constant currency in Q2 2025.
Faster than the instruments themselves.
Yeah, instrument sales were more in the mid-single digits. So the moat, that recurring revenue stream, is actually getting stronger.
And this moat isn't just about customer preference, it's actually embedded in regulations.
Correct. Waters sells what you might call regulated precision. They guarantee accuracy, reproducibility, data integrity, things that are absolutely non-negotiable in fields like pharma or environmental testing. The real competitive barrier here is something called analytical instrument qualification, or AIQ.
Okay, AIQ. For someone not in this specific field, break that down. Why does AIQ make switching so hard for customers?
So AIQ is this really rigorous multi-stage validation process. Think DQ, IQ, OQ, PQ. Regulatory bodies like the FDA demand it. Once a Waters instrument, and maybe more importantly its data system, is validated within a lab's workflow, changing it means revalidating everything.
Which sounds incredibly expensive and time-consuming.
Exactly. You just don't rip out validated analytical equipment unless there's an overwhelming reason. The switching costs are enormous.
And the proof of that lock-in is their software, Empower.
Yes, Empower is the #1 chromatography data system globally. It's deeply embedded in how the top 50 pharma companies operate. Trying to replace that would be, a nightmare for a lab manager.
Okay, so this fortress translates into stellar financials.
Undeniably. Waters' return on invested capital, the ROIC, is fantastic at 21.77%. Just compare that to rivals like Danaher around 6.7% or Thermo Fisher at 10.4%. Waters is just much more profitable on its invested capital.
But here's the paradox, the thing that really stands out from the sources. Customer surveys. They actually rank Waters below competitors like Agilent and TMO on things like product quality, price, even customer service. How does that square with the financials?
It's a classic vulnerability, isn't it? An incumbent potentially resting on its regulatory laurels on that moat. The financial strength masks this underlying issue. Customers might be stuck because of validation, but if they're not entirely happy, that creates an opening, a potential weakness down the line.
That weakness, maybe that ticking clock you mentioned, seems like the perfect lead-in to why they made such a radical shift. Let's talk about the leadership now. Chapter 2. Management evaluation. The new leadership and the strategic pivot.
Right. The shift really gained momentum when Dr. Udit Batra became CEO in 2020, and his background is incredibly relevant here. He was instrumental in orchestrating that huge $17 billion Millipore Sigma acquisition back in 2015, so he has direct experience with mega deals.
Okay. That context explains a lot about the shift in capital allocation. because historically, Waters just bought back its own stock relentlessly. That buyback yield hit, what, over 16% in 2019? That screams management thought the best investment was just themselves.
It did. But that approach is completely gone now. The buyback yield has cratered down to just 0.08% in 2025, a tiny fraction. All that capital, or the potential for it, is now directed towards M&A. Specifically, this massive $17.5 billion merger with BD's Biosciences and Diagnostic Solutions unit.
And it's structured as a reverse Morris trust. Can you give us the quick investor takeaway on why that structure matters?
Well, the reverse Morris trust is primarily a tax strategy. It allows the selling company, BD in this case, to spin off the division tax-free. For Waters investors, it signals the scale and complexity. You don't use structures like this for small, simple bolt-on deals. This is transformational.
Transformational is right. The stated goal is doubling their total addressable market, their TAM, to $40 billion. And they're targeting $345 million in annual EBITDA synergies by 2030. That's a huge synergy number.
It is ambitious, but the really critical question is why? Why this huge, risky bet right now? And it ties back to that paradox we discussed. The data suggests diminishing returns in their core business. Waters' normalized ROIC, while still high, has been trending down from highs above 45% just a couple of years back, down to around 24.9% by mid-2025.
Okay, 24.9% still sounds pretty good in absolute terms.
It is good, but the trend is the key. If your management, seeing that decline suggests your core business, strong as it is, maybe can't generate those super high returns like it used to. So you're kind of forced to look externally to acquire assets where you believe you can generate higher growth and better returns, like this BD division.
And we see that pressure, that need for external growth, reflected clearly in the numbers. Let's move to Chapter 3, Financial Analysis, the financial imperative.
Exactly. Waters is a big company, nearly a $20 billion market cap. But look at the top line. Revenue growth basically stalled for 2 years. Minus 0.52% in 2023, and then barely positive, plus 0.07% in 2024. That flatlining really underscores why they felt they needed this M&A pivot. They had to find growth somewhere.
But while revenue was flat, the profitability metrics held up.
Absolutely. Gross margin stayed stable, right around 59%, and the net profit margin remained exceptional at nearly 22%. That's almost 22 cents of profit for every dollar of revenue. Incredible efficiency.
So they have the operational strength and the cash flow generation.
Yes, and they clearly prepared their balance sheet for this move. Free cash flow bounced back nicely to $620 million in 2024, and crucially, they deleveraged significantly. The debt-to-equity ratio went from over 5.5 back in 2022 down to a very comfortable 0.55. That gives them the financial firepower to take on the debt for this acquisition.
Okay, and how does the market value this situation? What about relative valuation?
Well, the current TTM PE ratio is about 28.6. That's actually a bit lower than their own 5-year average, which was closer to 30. And it's definitely lower than key peers like Danaher at 43.3 or Agilent around 32.7. So it suggests the market is already factoring in a significant amount of risk associated with this huge merger. They're not giving them full credit for the potential yet.
That discount leads us perfectly into how the broader market is viewing this. Let's talk about Chapter 4, Market Sentiment. Analyst disagreement and targets.
Right. That valuation reflects the mixed feelings out there. The analyst consensus is sort of cautious, leaning towards hold or maybe moderate buy. About 69% are actually recommending hold.
There's a lot of fence sitting.
Pretty much. The average price target is in the $360, $376 range, suggesting some moderate upside from the current $331. But the range of those targets is incredibly wide. From a low of $300 all the way up to $483. That tells you there's fundamental disagreement among analysts about whether this BD deal will succeed or fail.
And how did the market react initially when the deal specifics came out?
Not well. The stock dropped 5.8% right after the $17.5 billion details were announced. That's a clear signal of investor concern about the size, the complexity, and the integration risk.
Okay, but interestingly, despite that concern and the analyst caution, the technical picture looks stronger.
It does. The stock price at $331 is currently above both its 50-day moving average, which is around $299, and its 200-day moving average, around $324. That confirms a longer-term technical uptrend is still in place, even with this merger uncertainty swirling around.
How do you reconcile that? Nervous analysts, a sharp initial drop, with the stock holding key technical levels.
It could suggest that while short-term traders and maybe some analysts are wary, The longer-term holders, perhaps the big institutions, are giving management the benefit of the doubt for now. They might believe in the strategic rationale or Dr. Batra's ability to execute.
Speaking of institutions, let's look at who owns this stock. Chapter 5. Ownership structure, institutional dominance and divergence.
Yeah, the ownership is heavily institutional, about 99.26%, which isn't surprising for a high-quality, large-cap name like Waters. The top three holders, Vanguard, BlackRock, AllianceBernstein, control a huge chunk, over 30% combined.
But are they all on the same page regarding this big strategic shift?
That's where it gets interesting. There's divergence. AllianceBernstein, for example, boosted its stake by a significant 31%. That's a strong vote of confidence in the new strategy.
Yeah.
But on the other hand, BlackRock trimmed its position by about 5%. So you see this debate playing out even among the largest, supposedly smartest investors. They're not all agreed on whether this risk is worth the potential reward.
What about the insiders? Manage it themselves. Are they buying or selling?
Insider ownership overall is quite low, only 0.11%. However, the recent activity is positive. Over the last 12 months, there were 22 insider buys versus only 6 sells. And critically, in the most recent quarter, right after the merger was announced, there were 0 open market sales by insiders.
That seems like a pretty strong signal of confidence from the people who know the plan best.
It does suggest management believes in the deal and its prospects. They're aligning their own interests with shareholders, at least in terms of recent actions.
All right, this brings us to the core challenge for any investor looking at Waters now. Let's pull it all together in Chapter 6. Risk assessment, SWOT, strengths, weaknesses, opportunities, threats.
Okay, let's recap. Strengths are clear. That powerful moat from high switching costs due to AIQ and the Empower software integration. Industry-leading profitability. And a solid IP base with over 4,100 patents.
The weaknesses are what drove the change, right? Stagnant organic revenue growth, that declining ROIC trend we discussed, and those customer perception issues regarding quality and service lingering beneath the surface.
Exactly. Now, the opportunities are potentially huge. The BD merger is the main one, doubling the TAM, pushing Waters hard into faster-growing diagnostics and clinical testing markets, plus realizing those $345 million in synergies.
And tapping into hot areas like biologics, which is growing at over 10% a year.
Correct. But then there's the flip side, the threats. And the single biggest one, overshadowing everything, is M&A execution risk. This $17.5 billion deal is the largest, most complex integration Waters has ever attempted in its 65-year history. If they stumble on integrating BD's operations smoothly, or if those synergies don't materialize as planned,
it could seriously jeopardize shareholder value.
Absolutely. Failure here would be very damaging.
And beyond just the execution risk of the deal itself, there are external macro and geopolitical threats too.
Yes, definitely. High interest rates can still trigger these biotech funding winters, which slows down R&D spending by Waters customers, impacting instrument sales. The Inflation Reduction Act, the IRA, could also potentially squeeze pharma R&D budgets, another headwind.
And you mentioned tariffs earlier. Those sound like a direct hit to the bottom line.
They are. New 2025 U.S. tariffs are significant. A 20% tariff on lab components coming from China and a 25% tariff on equipment from Mexico and Canada. Waters relies on global supply chains, so those tariffs will directly increase their cost of goods sold and put pressure on those excellent gross margins they've historically enjoyed.
Okay, so we have a very clear picture of the opposing forces here. Let's try to synthesize this into the final investment narratives. Chapter 7. Conclusion. The bull case versus the bear case.
The bull case is essentially this. You're investing in a fundamentally high-quality, cash-generating company with a strong moat. They're making a necessary calculated pivot, led by a CEO with proven mega-deal experience, to accelerate growth and unlock significant value through synergies in a much larger market. And potentially, the stock is undervalued given that potential.
Okay, that's the optimistic view. What's the bear case?
The bear case argues that management is being forced into this massive, risky acquisition because their core business is running out of high-return opportunities, as shown by that declining ROIC. The integration risk with BD is immense, perhaps underestimated, and external threats, tariffs, macro cycles, competition could easily combine to derail the whole strategy, even if management executes reasonably well. It's just too much risk piled on at once.
So how does this stack up against an estimate of intrinsic value? You mentioned a DCF model earlier.
Right, using a standard discounted cash flow model, and keeping in mind these models rely on assumptions like a 7.3% discount rate and 3.1% perpetual growth here. The illustrative calculation points to an intrinsic value of around $446 per share for Waters Corporation.
$446. Okay, so let's bring it back to the listener. What does this all mean? The current price is $331.10. That $446 estimate suggests significant upside. But that huge gap, that $115 difference, is essentially the market saying, we see the potential, but we are deeply concerned about the execution risk of this massive merger.
That's precisely it. The entire investment thesis from here hinges almost exclusively on management's ability to navigate this incredibly complex integration and actually deliver those promised synergies from the BD deal.
Which leaves us with the final provocative thought for you, the listener, to consider.
Given that $446 intrinsic value estimate, is the current $115 discount simply the fair price you pay to buy into the potentially transformative growth offered by the BD merger? Or is that gap a realistic reflection of the very high probability that the execution risks are just too great and those synergies might never fully materialize?
A lot to think about there. If you found this deep dive helpful, focused on S&P 500 stocks and powered by AI-driven research, please like and subscribe to Stock Analytics AI. Our members, for just $4.99 a month, get priority access to deep dives like this one. We're covering the entire S&P 500 over the next few months. And if you'd like a one-off analysis on a specific ticker, just drop us a super thanks.
And just a reminder, this analysis was generated using an AI system. It's intended for educational purposes only and should absolutely not be taken as financial advice. Always do your own research or consult with a qualified financial advisor before making any investment decisions.